The reason we do our work is to connect private capital to communities, providing financial products, providing education and access to impact investments is what we do.
We are what you would call a private credit fund, lending money to small and medium-sized businesses that they're not doing what they do to satisfy shareholders. They're completely focused on their client group, and their client group are vulnerable people who need their assistance to live fulfilling lives.
So the mission is to increase the amount of capital that's being invested in tackling social challenges in the UK. And that's all kinds of capital and all kinds of social challenges. We wanted to at least double the total size of the social impact investment market in the UK. It's not at least double BSC's balance sheet or our own investment or our own profit or anything like that. It's about the total market.
We don't believe in trade-offs at all. We believe that it's possible to build big businesses that are serving low-income people, helping low-income people to get access to the services they need, at the same time build big organizations and make money for investors.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Maybe we can start with an overview of Calvert Impact Capital.
We've been around 25 years. We are a nonprofit financial institution. So our legal form is a 501c3. Recently extended our corporate structure. So there's now a holding company called Calvert Impact Capital Charitable Inc. And we're building new products and services, both for-profit and nonprofit, under that holding company. Also under that holding company is Calvert Impact Capital, which holds our flagship product, which is the community investment note. And the reason we do our work is to connect private capital to communities. And so providing financial products, providing education and access to impact investments is what we do. Right now, we do that through providing financial products. We have a syndication business. We work with others to aggregate capital. We are a leader in impact measurement and management. We manage other people's money through various fund management roles over the years. And as I mentioned, we're right now growing new products as we see that there's gaps in the market.
This community investment note, what is it and how does it work, Pete?
That's our center of gravity right now. It is our flagship product. It's a fixed income product. It looks like a corporate bond. We sell it in 1, 3, 5, and 10-year increments for rates right now of 0.4% to 2.5%. You can access the community investment note 3 ways. One is online. You can buy a note for $20. You can buy it through your brokerage account. So you can go on the Schwab or the Fidelity platform and for $1,000 minimum, buy a note. Or you can just directly write us a check. And we have a track record of 100% repayment of principal and interest over the 25 years that we've been issuing the note. And the growth of the note has been exponential. It's 600 million, outstanding balance now. In 2017, it was 350 million. If you go back, it was smaller and smaller. We're always in the market raising capital, as I mentioned, always in the market deploying capital. So there's a sales team here of 4 people, 5, that go out. They work with financial advisors. They work with institutions. They educate them about impact investing and our note.
I've read that somewhere that your historical repayment rate is 99%, but investor repayment is 100%. So where's that 1% spread?
So, yeah,
where's it
no,
come
it's a
from?
great question. So when I say it's like a corporate bond, that's because they're buying our balance sheet, right? An investor is investing in the balance sheet of Calvert Impact Capital. 80% of the senior debt is the note, and then there's 20% of subordinated debt and equity beneath them, net assets. And so we have that buildup of net assets and subordinated debt, where if we have losses, we can absorb that loss and it not impact the senior note holders.
Okay.
All right. Gives them great comfort. So when someone considers buying the note, it looks like a corporate bond. It has a QSIP. It trades at par. And they look at the track record of our portfolio, the diversification. They look at the subordinate capital beneath them, and they get comfortable with that risk profile.
Within Calvert Impact Capital, which is what we'll be talking about, just help me understand, do you have separate funds that you're managing, or how is it? How are your activities structured?
We have a flagship product, the Calvert Community Investment Note.
Right.
The capital we raise through that product is full recourse to our corporate balance sheet, and it's the senior note position. We then lend or invest that capital that we raise in a diversified portfolio. Right now, and that's an open offering, so we're always in the market raising capital. It has a prospectus that we issue annually. And right now, it's $600 million roughly in US dollars. Over time,
How much did you say?
$600 million.
Okay.
Right now in a moment in time. Over time, we've raised $2.5 billion through that product. So that's been our flagship product, the engine that drives.
Could you paint the big picture, or give me a big picture overview of what the community investing space looks like for someone who doesn't really know it? And then where does Calvert fit into the overall space?
Yeah. So if you think about, in general, what we invest in, what the community investment space invests in, is investable opportunities that traditional banks don't do. So this is what JP Morgan doesn't do. Affordable housing projects, microfinance loans, renewable energy that's new and novel, rural communities, Black-owned businesses. There's something about each of these transactions where the perceived risk is higher than the real risk. And because we work close to these communities, we understand these markets, and we have increased comfort investing in these businesses or these projects. So we see a different risk profile. And so to move the money into communities, what we have found is there's a whole bunch of private capital over here, that there's a set of community intermediaries that are working with that private capital. They're offering them products and services and education to invest their money in another set of intermediaries that are community-facing intermediaries. These are microfinance institutions, affordable housing developers, community development, small business lenders. They sit in communities. They sit close to the projects. And a whole bunch of us that sit here, like Blue Orchard, like Responsibility, like Calvert Impact Capital, we're raising money from investors and investing it in these intermediaries and impact funds that are sector or geographically specialized, and they are finally on lending it to businesses and projects in place. Unlike traditional finance, there's a lot of intermediation to move this capital in.
All right. So are you very similar to Blue Orchard, for example?
Yeah, we sit much closer to Blue Orchard, to a Responsibility. We are creating investment products to bring private capital into impact investments. But we are not making a direct business loan. We are not investing directly in affordable housing project. We are investing in intermediaries that then lend to the business, to the project, to the person in place.
Where do you fit in? And then is there a difference between you and the other players? So who are the big players that are similar to you? And then how are you not similar?
A few things about who similar to and where we sit. This little silo we're talking about, the Blue Orchards, the Responsibilities of Calvert Impact Capital, what we're doing is we're structuring products that meet investor demands, right? They have demands around liquidity, around risk diversification, right? No investor wants to have a direct investment of $5 million in Tanzania. right? Investors want an investment that's 5 years or shorter. However, many community investments are 10, 20, 30 years in duration. So we're solving for that problem. Size, an institutional investor, they don't want to make an investment less than 10 million, but you need product that has enough size that they can take a meaningful piece of it. So we're solving by aggregating, structuring a product that really meets those investor demands. And yes, someone like Blue Orchard is doing something similar. Us, responsibility. And then the list gets very thin. This is where we don't have a lot of actors. And to me, this is one of your questions. What is the most challenging problem in the impact investing space? It is this. We don't have a lot of good ways for mass affluent, for advised assets, right? A CIO that oversees a pension fund or a financial advisor that oversees a high net worth individual's client portfolio to really invest and engage in impact investments unless they take the time to underwrite and do diligence a direct investment themselves, which many people don't have the time, the capacity, nor the fiduciary bandwidth to do. So this is a thin piece of the market. And more, even though I would say we're a peer with Blue Orchard Responsibility, they design their products for European regulations. We're overseen by the SEC in the States and the US, and we raise US capital. So we're audiences. And so if you look in the United States, there's other players that issue community investment notes. No one's as big, no one is as established as we are. We have distribution into the large wirehouses. So we're wired in the walls. So a financial advisor can go to the Merrill Lynch platform, find our note and put it in client portfolio and have it electronically. It trades at par. There's daily liquidity. So mutual funds can buy us. That whole distribution feature is very unique to us. Many other community and investment notes just sell it directly to investors, right? You fill out a paper form and mail in a check. So it doesn't have wide access for investors. There's some other. Equilibrium is a private equity fund, as well as they have some debt vehicles. There's other funds like Jonathan Rose in the United States. He has an affordable housing development fund. But all these other products are for accredited investors only or qualified investors. They're LPGP funds, so often they're PE, so they fit into the alternative asset class. There's very few other products that fit into the fixed income or into a cash alternative bucket. Yeah. So it's a growing space, but there's still a very thin product selection. And it's where it's just it's hindering money to easily flow out of client portfolios into true investments.
You are accessible directly retail, right?
Correct. You can go online and buy a note for as low as $20.
And I don't think Blue Orchard is.
No, they aren't.
Okay, so I got it now. But what people want to know is, what are professionals like you doing? And we understand the high level what you're doing. But people want to know, so really, how are you doing it? How are you deploying capital?
Yep.
Yeah. So what happens when you start making the sausage? Okay.
So when we start making the sausage, as you said, we have a retail investor base. So our risk tolerance needs to respect a retail investor. So we're quite low risk.
Okay.
We aim to have a diversified portfolio across sectors and across geographies to minimize that risk. And we look to intermediaries, both because operationally we're all in Washington, D.C. We're not in the field. So making a direct loan in Tanzania or in South Africa it's a riskier proposition. It doesn't align with our risk profile. So we lend to intermediaries.
You don't have any offices anywhere outside of...
Nope,
okay.
This is it. And we travel a lot, but this is it. And that's our theory of change, too, is that if we can create impact funds, financial institutions in communities where there's not good access to capital, if we can capitalize them, then that's a sustainable reliable capital source for those businesses in place.
Can you give me an example just one example that ideally captures your strategy in terms of someone invests in you and then you take that money and then what was the impact both from a financial perspective and then from an impact perspective?
So we lend into 9 impact sectors. So just as a headline, we have a different theory of change for each of those sectors: small business, affordable housing, renewable energy, etc. An investor can target their money to any of those sectors or untarget it, so they just support the whole portfolio. And so a very typical investment for us would be in Africa. There is a group called Sun Funder. They are headquartered in Kenya, in Nairobi, and they work across the African continent, providing businesses that provide pay-as-you-go solar capital to expand and grow. And so they're putting solar home units on individual homes that are not connected to the grid and providing solar power to hundreds of millions of people. That business model, pay-as-you-go, where an individual leases to own a solar panel, was a business model that none of the banks in Africa felt comfortable investing in. And so Sun Funder is a new fund manager that emerged probably about 8 to 10 years ago now to do that type of lending because none of the banks would do it. We were one of their first investors. We were a debt investor in a blended finance vehicle, so there was equity and other investors beneath our investment. And they've lent that money out and helped grow that renewable energy sector, the pay-as-you-go sector in Africa. Fast forward now, there's other Sun Funders across Africa, right? Other impact intermediaries doing the same type of work. The development finance institutions have heavily helped grow and scale this field. And now Standard Bank and other banks are starting to lend to these social enterprises, these businesses that are providing the pay-as-you-go. So what Sun Funder did is they demonstrated that these were investable assets. They built a track record. And then they went out and was able to share that with more traditional finance capital sources that could scale and grow the sector. And so we have about 70 million of exposure to Sub-Saharan Africa, solar renewable energy. And we probably won't do much more because we've been in there as an early investor, used our capital to demonstrate it's investable, crowded in a lot of DFI money. And now the traditional banks are coming in because they're comfortable with that asset. And to us, that's victory. Then we can move on to a new asset people don't understand or where the economics don't make sense to them because, again, they think the risk is much higher than the real risk that we see. And so we'll take a much lower return for those investments and build a track record in those assets as well, and hopefully pass them off as well. Some pass off, some don't, right? It's taken 30 years for microfinance to grow and scale and access capital markets. It's taken renewable energy in Sub-Saharan Africa a decade. Sustainable agriculture is still a broken market in some places. These are long-term. This is a marathon, not a sprint, but that's what our portfolio is doing.
So when you invest in Sun Funder, is that
Yes.
a debt instrument? Is that equity? What is it?
It's a debt instrument.
Okay.
There was equity beneath us in the instrument as well, but our investment was debt.
And you only do debt? Is that?
We have a few equity investments, but this goes back to just the profile of our investor being retail, so needing to keep our risk low.
So I guess the devil's always in the details, and that sounds like your model all depends on you working through MFIs or community development financial institutions, because you can't do this all direct, right?
No, and there's these intermediaries exist in all the different sectors. And so, it's hard to say what a typical transaction is because that intermediary lending, the type of investment we're making is consistent, but the shape, form, and structure is it varies. So like we were the first investor in the Seychelles Blue Bond. that was issued by the government of the Seychelles. So it's a general obligation to Seychelles. It's sovereign debt. But it couldn't float in the capital markets because it was only $15 million. So this was not going to hit any sovereign desk. It was too small, and the yield they wanted for the risk of the rating did not align. And so us two other institutional investors took that down. So, the blue bond, we have a sovereign blue bond in our portfolio that doesn't look structurally like some funder, but it's doing the same thing. This was someone needed to take the risk and demonstrate that it was investable. And we did that.
Do you feel that these are risk-adjusted returns?
The money in or the money out?
The coupons you're paying, because you are operating in what some people might refer to as funny places.
I do, because of our track record of 100% repayment over 25 years, because of the subordination beneath that senior note offering, because of the track record of repayment on our portfolio. I feel like we've demonstrated that we're operating in funky places, but that they're investable assets and that we are built for purpose. So the team that's doing this work understands these markets, understands the people we're lending to. We have a rigorous due diligence process, and that's all really important in being fiduciaries of their capital.
Now, I think you might have hit on this before, but I think you have three main strategies: balance sheet loans, structured debt, and asset-backed facilities. Is that correct?
So that's more just the products we offer. We can do anything. We have a bucket too when we report to our board that's called other. So that's more of a way we just look at our portfolio through a lens of risk. We divide it by what geographies that it's in, what type of products we're offering. Our strategy is build, grow, sustain. And it's really looking at new, growing, or sustaining intermediaries and providing them the capital they can grow and scale.
And do you use blended finance?
Everywhere.
Yeah.
Every transaction has a piece of blended finance in it. Every single one.
Okay, and so I mentioned before that all of this depends on your intermediary network. How do you do due diligence?
It is a rigorous process. We have two credit committees. One is a staff investment committee, another is a board investment committee. And we bring due diligence memos to these committees. The due diligence memo is extremely thorough. It's looking at both impact, capacity to repay, the character, the risks and mitigants. There's a pricing model because we do risk-based pricing. And there's a risk analysis that's based on ELR, probability of default modeling. And so it's extremely comprehensive. And we also then, once we make our investment, if it's approved, we do quarterly monitoring, both impact and financial. We do annual monitoring, and we have a very robust process to manage impaired assets. So a classified assets, an actively monitored list, where we always visit our clients. We do due diligence site visits when we underwrite them. It's been a little difficult in COVID. And we also travel and meet them at conferences. We talk to them on the phone. Many of our investments, if it makes sense, right, if it's not a closed-end fund, we renew and grow our relationship over time. So there's some partners we've had in our book for 20 years, and we have grown our investment as they have grown.
And I imagine you're working mostly in developing countries.
Correct.
And I know personally, I've spent, a lot of my career living and working in some of these places. And a lot of these are places where the rule of law is, let's say, isn't always the rule. And when there's money involved, there's often corruption, and sometimes on an industrial scale. So how do you vet your MFIs and your intermediaries? Because some of these places, they're professional and they practice on each other.
It's a great question. There's a number of strategies. One, we hedge everything. So if you think about the risk of local currency lending, because we do lend in local currency. If we do any local currency lending in our book, it's hedged. So we don't take currency risk. We also have a country risk model where we've looked and created a framework to divide the globe into A, B, C, and D countries, D being the riskiest, A being the strongest. And we've set limits on how much exposure we can have in any of those countries, very much correlated to their country risk score. So we have that framework. When we underwrite an individual credit, two things come into play. Often, a fund manager is working across multiple countries. So that helps to mitigate the risk. And oftentimes with these funds, we'll negotiate country or geographic exposures. So limiting investments in South Africa to 25% of the proceeds they raise, et cetera, and us and the other lenders. So this is not just us, this is the LPs collectively. There is negotiations just around country risk limits for these investments for paying. And then finally, we look at features in our risk scoring model around political stability, ability to get repay, strength of the rule of law, things like this.
And on a similar note, it's not the same, but it's kind of the same. Is there greenwashing? Is that an issue in community investing? If it is a thing, how do you avoid or deal with it?
Where there's greenwashing, I think, in community investing is not having an impact measurement and management process and infrastructure. So there is some community investing actors that just collect data from their borrowers and pass that back to their investor. But the operating principles of impact management, if you've heard of that, and we're a founding signatory, as is 200 other impact asset owners or managers, is we're advocating for people to have an impact measurement and management process. So take your investment at due diligence, how you collect data over time, how you assess expected impact, and looking at when you leave an investment, are you leaving with the impact in a positive place? So impact to exit, they call it. And so it's a whole process of impact measurement and management, and having it support your theory of change, your vision, and your mission is what the operating principles for impact management has been advocating for over the last 2.5 years. And that authenticity, that integrity of how you measure impact, I think is what differentiates authentic and deep impact from more of the reporting and window dressing.
So how do you measure and verify and report impact? How do you actually do it?
The foundational piece is we have an impact scorecard.
Yeah.
And so every transaction we put through our impact scorecard. It has a section on community impact. So looking at the 5 dimensions of impact that the Impact Measurement Project put out, which is best practice and what the field has coalesced around, as well as the ESG of that fund itself. So what their own environmental, social, and governance policies, procedures, et cetera are. So is that fund itself doing positive in the world? That's half of our impact scorecard. The other half is looking at the impact that our portfolio is having. So our investment in these intermediaries, the build, grow, sustain strategy I talked about earlier, we're assessing if our capital is providing additionality, if it's helping scale and grow, if it's tied to our vision and our mission. We take that scorecard, which is a set of questions, and we embed that in every due diligence memo. And it's a point of discussion, as is the ability for that entity to repay our investment. And then once the investment is made, we collect annual impact data We manage the impact risk of our investment. So if we see deterioration in the impact, we monitor it like we would monitor credit deterioration. And then when we exit an investment, and there's 3 of these on our website right now, we do success stories. So we assess our role in advancing the impact of that investment, that intermediary, that fund.
So this all sounds win-win. No one would argue with what you're doing, but you essentially are lending to people who have been left out by the traditional capital markets. I understand that there's 100% repayment, but are there increased risks in investing in,
It's a
in
great
these kind of organizations and projects? It seems like you've avoided it, although I don't know if you've ever had negative returns.
No, we've had some losses. Corruption happens. What we find is smaller funds run out of equity and can't sustain themselves and go bankrupt. Another big, one we're finding now is if a fund doesn't have personnel in place, if they're all sitting in Germany and lending into Africa, that's proven now for us to produce subpar results, that you need people in communities doing the actual. So we've seen, I think most things investing, there's patterns. We know our markets and we've seen patterns. And so those risks, because we are able to learn and we have also data, performance data, so we can actually track how certain sectors have performed over time, all help us inform what we believe the true risk of investments are, not what is perceived as risky by the market.
I would describe myself as being the founder and CEO of a social investment organization which aims to bring the skills and rigor developed in the career in mainstream finance to the amazing and inspiring world of charities and social enterprises, where we are trying to do our bit to help amazing social entrepreneurs and amazing organizations be the best they can be, so that they can help those disadvantaged or vulnerable as they cope with modern day society.
Sounds like you got a lot of work cut out for you then.
Yeah, no, unfortunately, that'll be never ending job.
Yeah. Around 2012, you co-founded Social Sustainable Capital. How do you get into founding a company by the name of Social and Sustainable Capital?
I never had a plan to go into banking. I think at the point I met Goldman Sachs at that recruitment, whatever it was, afternoon, I don't think I'd ever heard of Goldman Sachs before. So I don't think it wasn't on my radar at all, which is probably quite strange given that my father ran a business that wrote software for banks, but I don't think he'd ever really exposed me to what goes on in the world of banking, and I don't think I was interested in it. I think I was, if anything, I was probably, for most of my youth, I was probably thought I would be an engineer or something a bit more creative, but I think I just drifted into a business degree because I think as I became a teenager, I think I just got quite focused on the idea of personal financial sustainability, that I wanted financial independence. And I think that took me down that route. So I think I didn't have a passion for being a trader. I had a passion for financial independence, and I deduced that the best way to get that was by being a trader. Plus, I found the environment was appealing because I think as I mentioned, I think I probably was drawn to a kind of environment I hadn't really experienced before. And I would say, for the first 8 years of my career were adrenaline-induced excitement at the responsibility and the ludicrousness of the whole arrangement. I enjoyed the process of being a trader. I never engaged with the underlying things we were trading. I was never particularly interested in the underlying companies or what they did. And I did definitely have a negative reaction to the greed element of it all. So excusing my own personal greed around financial independence, I found taken to the extreme of the desire for wealth that there was around me, which increased ludicrously over the period I was in the city. I found that increasingly distasteful as time went on. So when I joined Lehman in 93, what was considered to be great pay for someone doing the job I did, 10 years later, around the time of the burst of the dot-com bubble was considered like a pittance. It was hysterical how people just kept adding zeros to what was an acceptable pay packet. And I think that I found that really didn't work for me. And I think partly because I think maybe the thing that was always there was this, I've got no issue with some people earning more than others, but there is an overriding sense of fairness, which I felt was an issue. And my wife at the time was teaching in an East End of London school, very challenging school environment. And I saw how hard they all worked and what they were getting paid. And it got to the point where the differentiations were they always were crazy, but they got ludicrous. And I think I just increasingly got frustrated and embarrassed about that state of affairs. So I think as time went on and I did better and better, and I reached, which I'm very grateful for, I did reach financial independence of one sort. Everyone's got a different view of what that is, but in my head, I reached what I thought was financial independence. As I got to that level, my tolerance for the things I found distasteful just diminished quite rapidly, actually. 5 years of my time in the city, I actually found it just really challenging to get up and go in every day, because I just found the prevailing attitude and the language and the approach and the view of the world that people who were focused almost uniquely on personal wealth I just found it really challenging.
If I had to summarize, you finally decided the bag was full enough and the environment was distasteful to your values.
It's actually more, it's that, and it's also a sense that I did used to constantly think to myself, I'm smart and capable. Surely there's something I can do that's better than this. I think now it became much more about that. I just got a bit embarrassed about what I was doing. I think it probably also has to do with having young kids who were desperately trying to understand what their dad did, and I just couldn't really explain it.
That gets easier as we get older. As long as you can give them the money, it gets easier.
Yeah, exactly. But I think that's really for me. And this is by no means, none of that is a value judgment on what people. I've got no issue with other people not feeling that way. It's just for me that is a challenge.
Maybe you could just give me a high-level overview of this company you co-founded, Social and Sustainable Capital, what it is you're doing, your mission.
So we're nothing like those people you talked about, those organizations you talked about. You're right. So there's a spectrum of capital where at one end you have red-blooded investment activity that's trying to maximize a financial return. And then as you move away down that spectrum, you have ESG investing and some of that good stuff, which is really important, really and large sums of money and helping to make big sums of money move the needle a small amount, which is really important. And then if you just keep going down that line, you keep going and you keep going and you keep going, eventually you get to us. The best way of thinking about us, we are what you would call a private credit fund, maybe what used to be called a venture debt fund, where we are working with we call them small to medium-sized organizations, but they're only because in our universe they're small to medium, but actually in any kind of international sense, they're micro. Their revenues are somewhere between zero and revenues between them £500,000 a year and maybe £150 million a year. So they're very small businesses on any kind of global scale. We are lending money to these small and medium-sized businesses that either are taking investment for the first time or investment is a small part of what they do, and where making a profit is a hygiene factor for them, but not something that drives what they do.
What does that mean?
Yeah. So they need to make money to continue to exist. And certainly the ability to generate a surplus year on year is really important to them to protect their business models. But as charities and as organizations of working with vulnerable people, they're not doing what they do to satisfy shareholders. They're completely focused on their client group. And their client group are vulnerable people who need their assistance to live fulfilling lives.
You've used, initially in your description, you used the word businesses, and then now you just started to use the word charities.
This is one of the misconceptions. So charity is a legal form. Charity also describes what people do, but it's a legal form. So I think when we talk to people and say we provide finance to charities, they think that we're providing financing to organizations that raise grants and donations and essentially give that money or provide programs. That is the kind of charities we're working with. We don't work with charities that are supported exclusively by grants and donations. That might be a part of what they do, but these are not-for-profit businesses. So these are organizations that are delivering services to local or central government. So they're businesses that deliver contracts, working with vulnerable people. They get paid for that service, and they may supplement to some extent with grants and donations. But when we're making investments, our investments are based on their ability to use capital to unlock revenue streams that can repay a loan.
In most situations, or in all situations, they're retained by the government.
Yeah, for us, for one of the things that SASC focuses on is practically everybody we work with is delivering services to local or central government.
Just to make it real, give me an example of what one of these entities that you lend to actually does and why they need credit and what they're
doing. A whole range of stuff. They may be helping victims of domestic violence. They may be working with people who are being released from prison. They may be working with children leaving the care system who have been in the foster care system. They may be taking care of adults with learning disabilities. In almost all cases, they're delivering some aspects of the statutory care that the government is required to perform for vulnerable, disadvantaged people. And so I guess if you scroll back far enough, all of this was delivered by government itself. And over the years, government has outsourced that work to people who know better or can deliver it more cheaply or whatever it might be. And why they need the money is because, just like any corporate, if you win a new contract to deliver a new service, there's a cost of building the ability to deliver that. I mean, this is in the most simple case, and someone has to upfront the cost of that. And then once the service is up and running and you start to receive payment for delivering the service, you can then pay down that initial investment. So essentially, what it all comes back to is we're providing capital that puts these not-for-profit businesses into a position where they can deliver a contract and generate a revenue stream. Now, this is where it goes back to what I said before. That revenue stream is necessary to create a viable, ongoing, sustainable business, but they're not in almost all cases, although they have one eagle eye on the revenue stream to make sure it covers the costs and generates enough of a surplus to have a healthy business. They're not profit-maximizing organizations.
Who are the owners of these businesses?
So they're charities, so no one owns them, which is another big issue, is they have no share capital. So as charities, there's no private shareholders. Now, that doesn't mean that there aren't private companies with shareholders operating in the same space. Yeah. And certainly in social care in the UK, there's an enormous presence of for-profit businesses and private equity. And that makes it quite challenging in some respects for the organisations we work with, as there's plenty of capital available for the very, very profitable contracts that are on offer. And so our organisations tend to mop up the very difficult to deliver low margin business that commercial money doesn't always want to. But yeah, it is a mixed economy of profit and not for profit.
Is this kind of blended finance? Or
yes, there is where that's a really obvious question and answer, and the answer is absolutely yes. So there's some areas of activity where in social investment that only organisations that either have a high tolerance for risk or, as you said, prepared to make it less of a financial return. Because I think the argument really goes, all impact investment provides a blend of financial and impact return. So I think, the non-answer is, on an overall, if these things are fungible, but on an overall return basis, these investments are really compelling. The financial return element might be lower, but you're getting, huge impact return. The truth is, yes, of course, the harder and harder and the riskier this stuff becomes, and there are lots of organisations in the UK, trusts and foundations, charitable trusts and foundations, to name a few, that are prepared to take what other people would consider as a below market financial return to be able to deliver these outcomes. So I think there's some areas where that's really obvious, where you're asking people to take a very high level of risk and probably a protect your capital, very low single digit type return. And then there's the bit in the middle where our housing fund is, where actually we meet charitable investors that consider the return to be more fitting of a more social kind of market. But we also have commercial investors in our fund who consider our returns to be entirely commercial. And that's because what the right returns is not, you can't really look at it in isolation. It's a function of the risk, function of where it fits in your portfolio and what you're trying to achieve. So so the area that we're in with our housing fund it's really hard to answer that question, because people have got a very different view about what a product working in social housing that yields it has a target yield of 6%, whether that is where that sits on the spectrum of commercial and non-commercial return. We would argue that actually that is a commercial return, and lots of commercial investors agree with us. Others would say that unless you're making 12% a year, it's not commercial.
Do you benchmark against something?
We benchmark our fund against other organizations that are both social in their mission and not social in their mission, or not as overtly social in their mission as we are, because everyone at the moment is claiming to be impactful in one respect or another. And I think the returns are in line with what you would expect for an unlevered social housing fund. And look, that's why our fund is growing, and that's why we're attracting the kind of money that we are. Because ultimately, there's no doubt about it that in order to be able to operate at any kind of scale, you do have to be able to offer a return and a risk profile that looks palatable and ultimately justifiable to investment committees and boards and directors who have to ultimately sign off on that investment.
Socially sustainable capital focused on investing in these charities and social enterprises. I guess there's two aspects to it. There's the impact element. Is that the best way to have an impact? And secondly, the financial return piece. I guess most people would assume that lending to charities is a dreadful idea.
The initial idea that you could help socially driven organizations to grow and help more people was extremely appealing. But as you said, you scratched your head and say, well, how can you make a fair risk-adjusted return doing that? The next level of our work back in 2012 and 2013 was then to take a bit of a harder look at the sector and work out actually how risky is this? And our feeling was actually it's not that risky if you do it properly, because often you've got government income streams. This is one kind of what I always felt coming from, as you noted on my CV, some organisations that at the time were considered to be great. But guess what? Lehman, UBS, well, Lehman did go bust. UBS and Merrill came very close on at least one, UBS on more than one occasion, Merrill on one. I constantly heard from people that worked in kind of mainstream finance about how the charitable sector is so poorly run, and if only they could be more like commercial businesses. And that did make me somewhat scratch my head of having been at the epicenter of total and utter failure of control and logic working at some of these big banks. So I was always curious as to why people thought charities that existed on tiny margins and tiny revenues were considered bad businesses when, businesses that earned billions could fail. And I think our initial work prior to setting up SASC, and I have to say, I think it's been confirmed for me, is that these are some of the best run businesses I've ever met. They're not trying to do the same thing that a commercial business is trying to do. And that's the problem. If you judge a not-for-profit business or a charity in the same way as you judge a for-profit business, of course, it doesn't look like it's as well run because you're assuming that both are trying to achieve the same thing. A charity is not trying to achieve profit maximization. And when you start to understand that and start to understand the headwinds that they're constantly facing, you realize that these are actually really well-run businesses. Not all of them, but enough of them such that they're backable and they can be encouraged to replicate or reach some kind of scale.
But why don't we drill down on the social housing fund, maybe give an overview of that fund and the impact that you're targeting to achieve with that?
So it's very specific and easy to understand, I think, if I can explain it. Working with vulnerable people in the UK involves two things, typically. It involves providing them with the advice and support that they need to overcome an issue that they're facing. Maybe that they left a violent partner, that they've come out of the foster system, they've come out of jail, they're living with a learning disability, whatever it might be. So part of the role of these organisations is to provide the support that's needed to help them overcome that. But another part of it is to ensure that they're living somewhere suitable and safe. Charities have been trying to deliver this dual kind of outcome, but they've had one hand slightly tied behind their back because they've been relying on external parties for the housing element. So they maybe been relying on the council or housing associations or private rental sector to ensure that there were suitable properties available for their clients that would hopefully help their recovery or their transition or their life or their ongoing situation, but certainly not hurt the chances of developing a stable living situation. And what became clear to us as we were involved in this phase was actually more often than not, housing options were really poor. They are either well-meaning but not suitable at one end of the spectrum, all the way down to unsuitable and frankly slightly scandalous in terms of the condition of some properties that existed in the private rental sector. Now, That's disappointing, but not completely surprising, because there's no reason why the private rental sector in the UK, where the average number of properties owned by a private sector landlord is one, why that would be a body that could be relied upon for housing disadvantaged and vulnerable people. The market, for whatever reason, and there's a whole separate discussion about the housing market in the UK, has evolved to quite an unsatisfactory place. But what we were faced with was a situation where these charities that could do a great job with people were underperforming because they just could not access appropriate housing. And we, in our travels in trying to understand how we were going to make a positive impact on the world, discovered a group of charities that had taken their fate into their own hands and found ways to become their own landlord and either rent or buy properties and take control of the housing stock and use those houses that they owned and leased to ensure that the interventions they were delivering were located in appropriate living accommodation. And what we saw was just huge change in the level of outcomes that organisations that had access to those properties were able to achieve. And so we looked at the space and said, we need to have a fund that allows residential property to transfer from the commercial profit maximisation space into the charitable space so that it can be offered to clients alongside the support services that charities offer. So we were focused on providing that finance. Now, so that's philosophically what we're doing, practically what we're doing. If you're a charity, you probably can get a mortgage, and some of them do have mortgages. But because of the risk-averse nature of charities, we found that there was a limit to how far they were prepared to extend themselves to purchase this housing, to build these property portfolios. And what we understood over time was that the reason that was the case was because of the nature of a mortgage. And there were some certain factors about mortgages that they found off-putting. The requirement to come up with a deposit, the fact that they were exposed to house prices, the fact that they were exposed to voids and to government payments, and the fact that they could never really be sure, because of the fixed nature of mortgages, that they'd be able to cover the ongoing costs of these houses. So what we realised, given our experience of working with charities, was two things. One, that if we could find a way to share some of those risks or to pass some of those risks from the charities onto the investor base, that would enable them to consider taking on investment. And number two, because of the work we do with the investor base, and because we have been investors ourselves, we realised that the risks that the charities wanted to rid themselves of were actually things that in a great many cases investors were not going to be worried about. And in fact, actually, in some cases, we're actually positively trying to seek, i.e. exposure to government inflation assets that increase in value with inflation. And we spotted an opportunity to create a very simple structure that de-risked the proposition for the borrower and increased the risk proposition for the investor, but that would still allow the capital to flow.
So how does it work? I've understood you have kind of a unique mortgage instrument or product or structure that you use.
So it essentially looks like a mortgage in terms of the legal documentation, but the couple of things that are unique about it are that we provide 100% of the funding to buy the houses, that we have a charge over the houses that are purchased with the money we provide, but not over the wider activities of the organisation, that our return, our interest, is performance-based, so we don't have a fixed level of interest. We look at the rental income of the property portfolio, deduct agreed costs with the charity, and then we receive the balance. So every quarter it's a different amount based on the performance of the portfolio, of the charity and of the houses themselves. And then the final significant difference is at the end of 10 years, what the charity owes us is a percentage of the value of the properties in the future as opposed to a fixed amount. So if they borrow £1 million from us, in 10 years' time, what they owe us back is 85% of the value of the properties, regardless of whether that's more or less than what they borrowed from us. Yeah. So they operate the houses for 10 years and they're guaranteed an equity position in the properties at the end of the 10 years. And at that point, they can use that equity to then go and get a commercial mortgage and buy the properties.
What is the equity position they end up with?
So they end up with a 15% stake in the portfolio, regardless of the valuation of the portfolio. If they buy £1 million of houses and in 10 years' time, those houses are still worth £1 million, they only have to pay us back £850,000. So they basically earn their way into an equity position in the housing. Now, obviously, our assumption is, and it's with UK property, it's proven to be the case, so the worst performing 10 years in history is an increase of 1.4% a year. So if the maths is right, in 10 years' time, these houses will be worth more than they were paid for them. And so the discount gets the fund back slightly more than was lent at the beginning of the life of the transaction. And the fund overall says, on average across the UK, we're going to see a continuation of steadily rising house prices, so that on a fund level, the money we get paid back at the end will be more than we lent at the beginning. But what it does do for the individual charities in each little geography and each individual transaction, they are insulated from being in a negative equity situation.
How do you actually select an investment and make your investment decision?
We're looking for a couple of really key things, actually. I think the first is we're looking for organisations of a certain size. So we're typically looking for organisations with revenue of between £1 and £30 million, because this is from an impact perspective where we think our money can create the most social impact. We, like any investor, we look for really high-performing management teams and really great boards. That's really critical to making social investments. We look for organizations that have experience of managing, so we understand they're on a journey and we're part of that journey, but we need to be able to see a track record of how an organization manages housing stock, because that's the bet that we're taking, really. We really importantly need to understand that they're a partner to their local commissioners, i.e. local government. We reference check with ultimately the organisation that's going to be the purchaser of their service. And we really need to understand that there's a close, trusting relationship between them and that local commissioner. And we need to really make ourselves comfortable that actually the provision of housing is going to generate better social outcomes for people. So it's really just evidencing that impact.
All right. So then can you give me like one real world example of the type of impact and financial result that you think you expect?
I can tell you the organisation, the interesting thing about this product is we didn't sit in a room with a whiteboard and a bunch of really smart finance people and come up with this structure. Was genuinely co-designed with a charity without whom we wouldn't have landed on the structure. And that organisation is called Hull Women's Network. They're in Hull, in the northeast of England. And we met them quite early on in our journey, and their story was really clear. So they, at the time we met them, they had 99 properties that they managed in the Hull area. They helped women and their children fleeing domestic violence. The statistic they quoted was that women on average flee a violent perpetrator on 7 occasions and return before they finally break free. What they could demonstrate was that by providing an appropriate safe house, women left on the first occasion and never returned to the violent perpetrator. Mm-hmm. So you basically, I think you don't need to describe that social impact any more than that. For the evidence, we were completely blown away by that just providing the right kind of housing meant that women and children could avoid 6 return visits to a violent perpetrator who may actually ultimately kill. And so we said, that's great. Why don't you have more housing? And they said, because we don't have the financial risk appetite to take on more, because ultimately our goal is to stay in business. And if we take on a lot more housing using conventional structures, we run the risk of not being around at all. So we accept a much slower rate of growth because we must endure, we must always be here. And that's how we got into the discussion with them about there must be a product that would make it possible for you to grow. They had 300 women on the waiting list that were trying to flee violent partners. There wasn't a way of growing their portfolio such that they could help those women. Since that time we met that organisation in 2017, with our funding, they have bought somewhere between 80 and 100 houses, which they now help women flee domestic abuse on a regular basis. And there's a never-ending list of stories of women and children who have been able to rebuild their lives after sometimes many years of misery and pain.
What's the total AUM in your housing fund?
This fund is a 75 million, the first one.
Yeah, okay.
Which actually, to be honest, not only is that extremely large in the social investment world, actually, if you look at the comparable world for us, which is small private venture debt part of the market, is actually in line with a lot of commercial funds as well. It's not out of place to a green bond fund or to a big listed equity fund that isn't large, but it isn't out of place. There are plenty of asset managers in the UK doing fully commercial business with funds in that zip code. Our next fund in the housing space is going to be 150 to 200. So for us as an organisation, we are short-term goal of 250 AUM, medium-term goal of 500.
What would you say the benefits are to your investors?
This is really the real trick with impact investment, is that the benefits to investors have always been the same. It's the ability to make a fair return doing something you can be proud of. The truth is, 3-5 years ago, there were lots of people who believed that was the right thing to do, but there were a small group of people who felt they actually could do that, whether it was because of their mandate or because of the fiduciary responsibility, et cetera, et cetera. There was only a small group of people who felt that they could say, this is the right way to make an appropriate return, so we're going to do it. What's changed over the last 2 to 3 years, beyond recognition, is that not only do people recognize the importance of putting some of their money to work in something that generates something other than the pure financial return. Actually, I'd say that many investing bodies are actually nervous about not being able to say what it is in their portfolio that is doing that. So we are finding that people are either pushing themselves to understand what is available in the world of impact investment at our end of the spectrum, or in some cases, their stakeholders are pushing them quite hard towards us. I could tell you there are asset managers in the UK that manage the large sums of money that sit in charitable endowments, where the charitable endowments are saying to the asset managers, what exactly are you doing with your AUM that is socially impactful? And some of those asset managers may be losing mandates because they can't describe what it is that they do that's impactful. When you lose a mandate, you can put a very clear number on what it just cost you to not be doing something more impactful. And that is definitely helping organizations consider the best way for them to do impact investment in the UK. So I would say that if you look at the journey of SASC, for many years, there was an absolute bar that we as an organization needed to get over to be able to attract commercial money. And that absolute bar was too high because of the nature of what we did. What's happened now is that's rather become a relative bar. Organizations are saying, we need to do something in the impact social investment space. What's the best fund available? So we've gone from having to reach some artificially high bar to now just having to be the best product on offer. And not everybody agrees, but there's enough people that believe that our product is the best thing on offer. And as a result, we're engaging a far broader range of investors than we would have thought possible.
You've described all the benefits to investors. Primarily, the revenue seems to be coming ultimately from the government. You've described the impact that nobody could argue with and everyone would want to be part of, and you're benchmarking somewhere in the high single digits, 5 to 8%. So this sounds like an investor win-win wonderland. Is there any downside to this?
The downside is we're a small asset manager that started running money in 2014. Ultimately, for some people, it's a challenging area because we're funding organizations that are working with vulnerable people. The funds are very long dated and they're completely illiquid. You invest in 2021 and you don't get your money back to 2032 and there's no liquidity. I think actually people would have said the risk profile of housing benefit, this is pre-COVID, they would have said, the risk profile of housing benefit is tricky because governments cut spending, et cetera, through COVID. It's the only area of the property market that you have not been absolutely, crushed in, because if you're investing in housing or in commercial property or hotels or shopping centres, obviously you've had a torrid time.
There seems to be some kind of a natural tension between delivering a financial return to investors on one side and then you're deploying capital to companies that have real urgent human needs. Is that something that you have to manage in a certain way? Or
and that's the secret sauce, if there is a secret sauce for SASC and any other organization in this space, is being credible to both sides of this problem, right? So we, I think somewhat uniquely, have two stakeholder groups that are very different. Right? So if you're a venture capital business, you're talking to investors and founders who are both trying to make a lot of money and everyone's on the same page and it's really straightforward. We, as an organization, have to be able to engage with organizations that are motivated almost entirely by purpose and in some cases may even find profit quite a challenging concept. And on the other side, we're working with investors who are increasingly interested in purpose, but ultimately when it comes down to it, there's an underlying financial incentive, and that's tricky. And it's quite a hard place to live in that grey area, impact and between purpose and profit. And I think that's what we do well. It's constantly reassessing the construction of the products, how we market, who we market to, who we engage with, who we work with. It's hard. It's sometimes we say, who knew how hard it was going to be to try and do a little bit of good. We aren't delivering the social outcomes. We're supporting organizations that are doing the hard work to be clear, we're in a supporting role. We don't claim the impact of the organisations that we provide finance for. But it's been surprisingly hard to create a sustainable asset manager in the space because it isn't something that, left to its own devices, capitalism probably would have found. As you say, it's an interesting clash of cultures.
You originally were funded by charities or charitable organizations who probably weren't interested as much in a commercial return, but it sounded like you're getting more, perhaps pension funds or other organizations that clearly have a fiduciary responsibility, but maybe because now they have to report on the impact that their investment activities are having, are interested perhaps in, but at the same time, they have a fiduciary responsibility on return on the assets that they're managing. Has this changed by a big percentage for you?
2-3 years ago, it was hard to see. We've been going for 4 or 5 years, and it wasn't clear how we were ever going to make the change away from that small group of highly motivated investors that would allow us to do what we were doing, but ultimately could never provide the scale of capital that would allow us to do things in a meaningful way. And then it all changed when the investing world discovered impact. And whereas, as you say, ultimately, the truth is, 3 years ago, it was very hard to speak to an organisation with £1 billion fund and persuade them to part with £5 million into something like us. Now, the argument is, I've got £1 billion, it's just a £5 million investment, and it's really what we need to satisfy people that we're thinking about the way we invest. The whole argument's been turned on its head. It's gone from being too small to be relevant to very relevant and helpful, that ultimately it's a small percentage of people's financial exposure. It's been a sea change. I think initially we thought it was a threat because I think there still is this risk. If people don't understand the difference between green bonds and what we do, organizations may have a small portfolio of green bonds and say, that's it, that's my impact investment done. But actually, I think that initial fear has gone away, because I think actually people really do recognize the difference between an organization issuing a green bond and providing capital to an organization that helps women flee violence. I think people do understand that. And it may be that the investor understands it, but says, I understand the difference, but I cannot do what you're doing for reasons X, Y, and Z.
Yeah.
But that is still positive.
What do you know now about social investing that you wish you knew in 2012 when you founded the Social and Sustainable Capital?
That success would come from more listening rather than more talking.
So for people who aren't familiar with Better Society Capital, give me a high-level overview of BSC and help us understand what you do, what's the mission that gets you out of bed in the morning, what are the problems that you and the organization are trying to solve, and what's the theory of change that guides the organization?
So the mission is to increase the amount of capital that's being invested in tackling social challenges in the UK. And that's all kinds of capital and all kinds of social challenges. And the way we approach that is sort of twofold, in two linked ways, into sort of theory of change bit, in that we have our own capital to invest, and we aim to do that in a way that grows the overall market and brings in other capital alongside us. And we also try and more broadly create a set of conditions that encourage investment to flow towards social impact in the UK. So we are sort of directly investing and then enabling others to invest by creating a sort of wider set of conditions. And the crucial part about our approach and so who we are is that our key KPIs and measures are all about the market as a whole and growing the total impact investment in the UK rather than just growing BSC's impact. A key metric for our current strategy is we wanted to at least double the total size of the social impact investment market in the UK. It's not at least double BSC's balance sheet or our own investments or our own profit or anything like that. It's about the total market. And those, all the key KPIs at that sort of level. The theory of change is that we can use both direct investment and that sort of work around the system to enable greater amounts of capital to flow, which then will reach more organizations, which are in turn then creating the direct impact. So we sit at a wholesale level. So we invest into funds. The funds invest into frontline organizations, charities, social enterprises, mission-driven businesses, which then create impact for people on the ground.
We're going to drill down more, like to make sure we're all on the same page. Break down social impact investment for those who might be new to the concept. How would you explain it to someone who's never heard of it before? And what makes it different from traditional investing?
The crucial part of it is we're looking to make investments that have a financial return, but also a measurable positive social impact. And that is the absolute crux of it. Linked to that is we are generally, in fact, for us, pretty much exclusively investing in the investment is flowing to organizations where creating that measurable positive social impact is part of what they're trying to do. It is not just a byproduct of the activity they're doing anyway, but is in some way integral to their mission. And that may be because they are a charity where that's the case, or they might be a company that's baked into articles or whatever, some other form. So money is flowing to organizations that are trying to create a positive social impact and are assessing themselves on that basis, but is also creating a financial return as well.
Every field has its challenges. What are the biggest barriers you face in social impact investing? And what misconceptions do you constantly have to battle against?
Misconception, one of them is, and this is a constant misconception, is that there is some kind of relatively linear trade-off between financial impact and social impact, and that higher financial impact investments will be lower social impact, and you'll have lower financial returns on the higher social impact investments. There clearly are cases where that is true, but if we look at our portfolio, it isn't true at a portfolio or even at investments within funds, that the investments we have that have the greatest social impact and that we've measured and tested that are not particularly the ones with lower financial impact. So it's not a line. It's not even a kind of curve. It's more like a scatter chart. You actually can't really find a correlation at all. So we have low financial and low social impact investments where it just haven't worked at all. We have high financial impact and low social impact investments. We do have some of those. We also have high, and we have ones which are in the other quadrant. So we've got the whole scatter chart. There's a narrative that is very common and this is actually interestingly both from investors in the more financial sector, but also from the sort of the social sector and charities saying, well, there's a trade-off here, and where are you on the spectrum of impact versus financial returns? And well, that's not our experience after doing this 12 years, that it works that simply. And there are trade-offs and choices you make in there, but it's not a linear thing. Then back to the barriers, that misconception and others, I think that the main challenge we have is simply that we're as yet not big enough. The scale of the challenges and the scale of the capital need is so big that social impact investment has got to get bigger to make a dent in them. So to take an example, one of the biggest growth areas, which we've been involved in alongside others, is investing in social and affordable housing in the UK. So housing for people who often otherwise would be in temporary accommodation, potentially homeless, or women fleeing domestic abuse. We don't have a particular fund focused on them, all these sorts of areas. That market's gone from very little to a few billion, which is great. It is amazing. It's now housing thousands of people. But it needs to go from a few billion to several tens of billions to be anywhere near tackling the homelessness challenge we've got in the UK, which is arguably the worst homelessness challenge in Europe. We've scaled up a lot, and that's great. And we've been part of that along with others, not just us doing that. But to get to actually really tackling the problem, we've got to do another scale jump, which is probably harder than the first one. So that's the sort of thing that keeps me up at night. I mean, not too often, but the back of my mind is like, the market has grown 12-fold in the 12 years we've been working in this, and a lot of that's down to BSC. They're not just us, but we're still, the challenges are so big, and the amounts of money you could potentially invest for great impact is so big, we're not even close yet.
I want to go back over the funding story of BSC, which is fascinating. If my memory serves me right, I think BSC might have been created around 2012 or something like that. Spoke with Kieran Boyle a bit about it on a previous show. It was funded initially with 600 million quid, and 400 million quid came from dormant bank accounts and 200 million quid came from major high street UK banks. Where did the idea for that unique funding structure come from, and what made that possible?
The dormant assets piece, which is the dormant bank accounts piece, which is really unusual, came from a commission which looked into this back in, I think it's 2008, but I might have got that slightly wrong. And this, one of your other former guests, Sir Ronald Curran, that you've talked to, was the driving force behind setting it up and unlocking that money. And yes, it turns out that there's really a lot of money in dormant bank accounts, and this is bank accounts that haven't been touched or there's been no contact with the person for 15 years, so they're really pretty dormant. And the way it works, that you still have an absolute right to get your money back at any time if you can prove that it's yours after that long. But there is a lot of money there and it can be used for good purposes. But yes, Lonnie probably talked about this in your previous podcast, but he was absolutely instrumental to making that happen. And a piece of legislation, Dormant Accounts Act, passed in the UK to unlock that money for social purposes, including divisional capitalisation of BSC. It's now used for other purposes as well, because actually there's far more than that, 400 million in the pot. And then the high street banks came in, a part of a sort of deal with the then government at the time. This is post-financial crash. There was a whole load of discussions between government and banks about how they could sort of almost rehabilitate themselves to an extent after some of what had happened in 2008 and some of the things that had gone on, and contributing to this kind of initiative, I think, was part of that conversation.
Was this dormant money well known and talked about, or was it like a really best kept secret?
I'm not sure, because at the time I wasn't obviously that involved. I mean, as a sort of fairly well-informed public policy official working in other areas at the time, I didn't know about this, but I don't know how widely this had been talked about and thought about elsewhere in the system at the time. So it's a good question. But yes, it's subsequently other countries have looked into it and sort of tried to imitate the British model on this, because it's a really interesting one.
Well, Switzerland had a very different approach to that.
Well, yes, that's true. That is true.
How does having this unique capital structure influence what you're able to do?
It means we can be very long term, which is crucial, because we've got this sort of corpus of capital that we've been set up with, and we're able to take a long view, which is incredibly important. A lot of the funds we invest in are quite long term. And the things we've done that have worked and scaled have been things we've committed to over multiple years. Happy to talk more about those if people are interested in detail. It also means we're pretty independent, because this is not government money. So we are either seen by a trust, the oversight trust, which keeps us on mission, make sure we use the money appropriately and are well governed, don't waste it or anything like that. Quite independent. And so it makes it a little bit like a foundation. But then also we have having the bank shareholders who do keep an eye on returns and sustainability, and make sure that we are making investments that ultimately, hopefully, will return and then come back and we can reinvest them. So we're trying to be sustainable ourselves and build a sustainable market, but able to take a long-term view around that, which I think is a really fortunate position to be in, actually.
You've referred to your returns falling across the spectrum. What kind of returns are you targeting at the portfolio level?
At a BSC level, so this is net of all our costs, and not portfolio level, our return target is 1%, which it was originally higher, and that was originally 4 to 5%. And we concluded that wasn't realistic based on the sorts of things we were meant to be doing. That translates into the social investment portfolio is targeting a return of around sort of 3%-ish, 2 to 3%, because obviously we net off costs and cash we have to hold and various other things like that. I mean, it's fair to say you haven't achieved that over our lifetime, because you get a natural phase where if early investments we made, some which were a bit experimental or different that haven't worked out, or pay money out in the early days and don't get much back. So we're confident we will deliver that target, but so far we're a little bit behind on that because of a backwash of things we did, which some of which are, say, experimental or riskier or so on. But overall, net at the BSC corporate level, we're seeking a 1% return on a rolling 5-year basis.
And what are your capital providers expecting in return?
The Oversight Trust, which oversees the dormant bank accounts, I mean, they're expecting us to build a market which is bigger than us, is sustainable, has other players in, and draws in other capital alongside us. So they look for us to maintain ourselves while building a bigger market alongside us. And similarly, the banks, actually, they're looking for shareholders, they're looking for us to make that return and look after their money and be sustainable, but also to do it in a way that kind of promotes social impact investment more broadly and makes that a sort of thriving market in the UK, which is good for them and good for everyone.
In 2023, you changed the name from Big Society Capital to Better Society Capital. What was the story behind that decision, and what were you hoping to signal with that change?
We found that increasingly people found the name Big Society Capital a bit confusing, and particularly people coming newer into our space or who had been or overseas partners we work with or new investors they didn't really understand what this sort of big society concept was. It stopped making sense to people because it wasn't terminology that was widely used. And we found people finding it quite confusing. So we thought, okay, have a name that places actually what we do and is easier to understand, but we'd rather not give up the BSC. Lots of people abbreviate it anyway. There's brand value in that. We don't rebrand everything. Let's keep it simple, not spend lots of money on a rebrand. So something that kept the BSC, which a lot of people use as an abbreviation anyway, and actually says what we do, i.e. we're best capital for a better society, seemed to make a lot of sense. So we probably should have done it earlier, frankly, because once we did it, it seemed very logical. You agonize over these things, don't you, and take longer.
Give me a flavor of BSC's investment strategy. What asset classes are in your wheelhouse? What's the typical duration of your investments? And perhaps your typical ticket size, and what are the non-negotiable criteria for any investment that you make?
All investments we assess against 3 pillars, which is financial return, impact, and what we call systems change, which is their contribution to building that wider market and bringing another capital or breaking new ground or otherwise somehow moving the market on and changing the wider system. So those are the pillars, and meeting at a base level on all those 3 is non-negotiable, and that's the sort of framework we use in decision making. I mean, the other crucial thing that is pretty much non-negotiable is we're a fund investor, so fund of funds investing almost at the wholesale level, and we do some co-investments. So therefore, we end up investing directly into a front line where one of our managers has already invested, but they originate that. But we're very much a fund investor. So, and we're UK. So although we might invest in a fund that has some elements outside the UK, there needs to be a big UK chunk of impact. It doesn't have to be 100% UK. There needs to be a decent amount that's the UK, and clearly has to create social impact. So within those parameters, we do most things. So we invest in funds that are doing equity, that are doing debt, that are doing real assets of one sort or another. We invest in some very large funds, or we're a very small part. We invest in some small funds, or a very large part. So we invest with large fund managers who are trying to sort of move into impact space. We invest in some very small startup fund managers. So it's a really big range within the parameter of fund investments. I mean, ticket size, we will do some fairly small things, like £1 million. Our biggest individual investments are probably around sort of 20 million. That's pretty unusual to do 20 million into a single fund. We do quite a lot that are between 5 and 10 million into a single fund. But there is a duration. Again, that varies quite a bit, but some are pretty long duration. Some are open-ended, some are 7-year funds, 10-year funds. So we do tend to operate on quite a long time horizon. Yeah, the nature of those sorts of private asset funds that we're investing in.
BSC focuses on 4 verticals: social and affordable housing, social lending, social outcomes, and impact venture. How did you decide on these 4 areas, and what was the process you went through for selecting them?
This was on the last strategy sort of update which took place just sort of coming out of the pandemic, and I was quite new as the CEO, and really it was about looking at where we saw some traction, progress, where could we see that there was some movement begin to attract other people, and where impact was happening. So it was just a sort of fairly pragmatic. There's no sort of great art around it. It's saying these are things where we can see that we can make investments, is working, and we can see that there's a chance we could sort of express and communicate what meaningful goals were over a 5-year period. If we're growing those markets, we could sort of see a path to doubling, or in some cases more the size of those markets. So yeah, there's nothing sort of wildly sophisticated about those areas, but they're a sort of crystallization of where we saw things we could make progress on, where we added value, and there were partners who'd come with us on that journey.
Could you walk me through each of these verticals? And when you do, I'd like you to highlight what makes each one of these distinct, and how do they differ in terms of risk and return expectations, and importantly, impact potential.
Starting with the social and affordable housing, that's probably the easiest to explain, really, because it is what it is. Housing for people excluded by the mainstream housing market. And particularly in the UK context, this is a really big issue, because housing problems and the lack of affordable housing underpin a whole load of other social challenges that people face. So it is a very big challenge here in the UK. And we invest in this market a mixture of sort of what we call general needs of social and affordable housing for just people on low incomes who need housing, and then some housing models that are targeting particular groups with particular needs. So that's, as I mentioned earlier, women fearing domestic abuse, children leaving the care system, ex-offenders, people who've had a history of homelessness who need some additional support, additional kinds of provision, more specialists. So we do both of those things. And this area is scaled pretty fast. But as I also said earlier, the need for more money is even greater. The needs are very large indeed. Impact venture. So this is really the view that some of the techniques and tools and approaches of sort of venture capital investing in startup, tech-driven businesses, some of that can be targeted to social good. And there's been quite a movement in a lot of it in London, actually, around what sometimes gets called tech for good. So using that sort of innovation ecosystem that we see more broadly in Silicon Valley and elsewhere, but using it particularly with a view of tackling social problems. And increasingly you're seeing founders who want to found startups, often tech startups, who want to make a significant social impact while doing so, as well as returning money to themselves and their investors and so on. So then third vertical, social lending, this is a bit broader. So this covers all sorts of debt finance to social purpose organizations. And that's everything from charity bonds, so large charities issuing bonds where we play a role of stimulating that market and ensuring that big issues get away, to our significant shareholders in two social banks, banks that particularly focus on banking the charitable sector or other non-profit organizations who sometimes have problems getting banked by the mainstream for various reasons. So Charity Bank and Unity Trust Bank, we're big shareholders in. And then other forms of debt finance. And this is often blended finance where there's a level of grant as well as loan capital going into often smaller, more community-based organizations. And there's a whole range of funds do that, including some that are more geographically based in particular parts of the UK. And the final one, social outcomes contract, which is the smallest of four. This is where public sector bodies, and whether that's local government, central government, or the health service, are commissioning services on the basis of outcome payments. So they're saying if you can, take these young people at risk of dropping out of school, if you can support them in various ways so they get through school, pass their exams, and go on to a good future, and then we'll pay X £1,000 per person. Now, lots of organizations, those social sector organizations deliver the services that get paid on that outcomes based, obviously need upfront capital to run the services, can only get paid later. So the role of an investor, i.e. us and others in this case, apply that upfront capital enables people to deliver against the outcomes contracts. And it's the smallest area, but it's really high impact, it's really interesting.
I'd love to hear some real examples of investments that you've made and to know what kinds of returns you've achieved and how do they compare to conventional investments in similar sectors.
On the property side, there's a whole set of funds we invested in from a fund manager called Resonance, who are a social impact dedicated fund manager in the UK. And their model is to, their funds purchase houses, just normal houses on normal streets, and refurbish them and then let them out on long leases to charity partners, charities who work with people who are in very high housing need, usually people who are otherwise living in temporary accommodation. And temporary accommodation in this context usually means terrible conditions in sort of bed and breakfast or hostels or really poor quality, like the one level above being homeless. And instead they're being given a stable, secure, long-term home with a charity that's managing that and supporting it. So we've invested in a whole set of funds in that space. We invested in the very first fund that was housing, it was 50 or something people in London. And that model is now housing a few thousand people and going really well. Started to raise money from some pension funds, our more institutional investors, where the first investors were more us and foundations, that kind of stuff. And those funds are still maturing, but the earliest one, Real Lettings, has produced a pretty decent return. I think it will be in the high single digits return performance on that, which will be X as well as exhibition impact. So that'll be a good example. In the impact venture space, so there's a really interesting fund there called Fair by Design, which we developed sort of proactively with a partner and Joseph Roundtree Foundation, one of the biggest foundations in the UK, plus others, which aims at investing in startup businesses, mainly tech businesses, that tackle the fact that people in poverty pay more for crucial goods and services. So if you're poor, you pay more for your energy, you find it hard to get banking services, or you pay more for it, you find it hard to get insured, or if you can get insured, it's expensive. All these things have a sort of cost premium if you're poor. And that fund invests in businesses that try and tackle that and then measures how much money it saved people. It's, the savings are really quite impressive. And there's a particular company invested in which has driven the overall fund is returning very well. And I think a company they invested in there called Wage Stream, which basically tries to mean that people don't have to use high cost payday credit by partnering with big employers, enabling people to essentially borrow forward against salary by small amounts of money. Otherwise, you'd be going to predatory payday lenders, basically. And they work with big employers who have quite large numbers of people on fairly low incomes who need that service. And they've been extremely successful. They're now raising money from sort of commercial venture capital fund, but their sort of first key investor was this impact-driven fund that we'd endorsed, and that's both the commercial and impact success at a real scale, which is really interesting.
There's this persistent narrative that social investments can't deliver competitive financial returns. Based on your experience and the data you've seen, what's the truth here? How do you respond to that sort of criticism?
They definitely can do. They don't always. And some of the examples I've talked about there are really pretty financially, commercially successful, as well as delivering great impact. Something like Waystream or Urban Jungle or many of those outcome contracts. I'd say not everywhere and not everything. And there are parts of the market that are not suitable for more fiduciary commercial time investment, but there are parts that are. And one thing we've done at BSC is we launched back in 2020 an investment trust. It's a partnership with Schroders, a fund manager, so the BSC Schroders Social Impact Trust, which is a listed investment trust available on the stock exchange for anyone to buy, where we package together a set of investments, which are some of the more tried and tested ones, if you like, in a vehicle that anyone can buy into. And that's credible. And that people have invested in that. And so it shows that you can create something that looks, feels a bit more mainstream, perhaps, and while also creating a clear, measurable social impact.
Which areas is this tension most acute?
The financial return impact sort of tension.
You are targeting a lower return overall at BSC in order to crowd in more private capital.
It's not just in order to crowd in private, it's also for a couple of other things, so that we can do experimental things, which we're not expecting loads of private capital to come into now, but might pave the way for private capital in the future. So we can do some of that. And it's because also we carry this sort of market building remit, which has a cost to it. So we're paying for that. So our BSC return is going to be less, partly because we're paying for a lot of that activities that we do for the benefit of the market, if you like, that a commercial actor wouldn't do.
What would you say to people who argue that very model proves that social investments can't produce a true market rate competitive return?
No commercial investor would invest in the whole BSC portfolio because it contains all these mixture of different things, including historic experimental stuff and so on. But at an individual fund level, you can see individual funds that are producing returns that are suitable for something where there is of commercial target. And indeed, our biggest single type of co-investor now are local government pension schemes. They're fiduciary pension funds that have responsibility to pay money to pensioners, and they're the single biggest source of people investing in the same funds as us. So that sort of demonstrates that at least parts of the market are absolutely breaking through that point. Others, there's probably more work to do.
But we as a society need to cover the whole spectrum. And so I guess your argument is getting a concessionary rate of return, and maybe where some of these pensions are invested, is necessary in order to cover the whole market and allocates capital more efficiently than, let's say, grants or philanthropy, so to speak.
Well, I mean, grants are a massive part of the story, and you need grants to do lots of things that social investment can't do. And you need grants and wearing another hat like chair, a grant maker, who also does social investment, but we're very clear the stuff we need to do because it's got to be a grant because you can't possibly invest in it. So you need a range of options and a range of tools. Either you can use grant smarter if you think about it as part of a spectrum of capital. And also, there's a thing about this of being dynamic. If something doesn't stay in the same box, you can try something, and when you do it the second time bigger, or having learned lessons the first time, then you can generate a different return or take a different kind of risk or whatever. So things kind of move along a journey. And part of BSC's job is to catalyze stuff at an earlier stage sometimes.
Let's talk about catalytic capital, which fascinates me as a concept. How do you define it?
Catalyze is the word, isn't it? That starts something that has potential to grow and become bigger. So I think this is, and so it's different. It's not necessarily concessionary capital, which is a different thing. That's more sort of, I see it sort of permanently taking a different position. But a great example of where we, I think, do things which are catalytic is by being a significant cornerstone in the first fund. A fund manager that wants to do an impact fund for the first time is trying something different. And if we buy into it and we think it's good enough, we're prepared to come in the first close with a significant ticket sometimes and make something happen. That's catalytic. You're taking sort of first mover risk almost. That's a great example of the kind of thing we do that I would say is catalytic.
One thing that caught my attention is your philosophy on impact. Your website indicates that the funds you invest in create the direct impact. So what is BSC's role? How exactly do you think about your impact responsibility, and what's the distinctive value you add to the equation?
We do often think about investor contribution, which is often part of the sort of the impact investing lexicon, but we think quite hard about that when we make an investment. So what is our contribution here? Would this happen anyway? What does BSC bring to this? So is it our capital we're bringing? Is it some advocacy or tool we're bringing? Are we bringing an impact framework that makes the fund more impactful? So that kind of investor contribution piece is quite important to how we think about an investment. And it's very active part of our investment committee decision making. Sort of is BSC, what are we doing here that is making something happen that is additional or wouldn't have happened? Gives something a better prospect for success than otherwise it would have had.
The policy environment obviously plays a huge role in what's possible in social impact investment. What policy elements are the most important for growing this market, and what barriers still need to be addressed? And given your extensive government background, How does BSC engage with policymakers to create a more favorable condition?
A week ago, published a paper basically on this topic through the Institute for Policy Research at University of Bath, where I'm a visiting fellow. So I'll try and summarize some of it. So we've become increasingly convinced of the importance of this, actually. I think there was a phase, actually quite a lot of my early time BSC, where partly because government wasn't that interested in engaging with this question, I think we thought we could get a lot done anyway. We got quite a lot done anyway, but in the last few years, we've sort of lent more back into this because we realised quite how important it is to unblocking stuff for us. So I think there's a few things that government can do. These are not mutually exclusive, you can do all of them. So there's government can be directly an investor itself and invest in funds and make them happen. And we've actually made some investments on behalf of government a couple of times, particularly in the homelessness space. Government can commission services in a way that facilitates impact investment contributing to those outcomes. This is my point about the outcomes-based contracting and so on. Government can create incentives like tax breaks or other things that say there's, for example, in the UK, we have community investment tax relief, which actually enables people to receive tax relief for investing in certain things which have a social impact. That could be expanded. You could do much more with those kinds of things. And then there's a kind of regulatory environment, often in particular sectors, where government's policies can be decisive on whether or not impact investment can work. So again, an example I've alluded to earlier around community ownership of renewable energy assets, which can be really beneficial and drive real both financial value for community as well as increased take-up of renewables. At one point, that was a big market because government has some sort of subsidy and regulatory regime that really supported that. The regulatory regime shifted away, it's made it much harder. That's now possibly being unlocked again. Those regulations are pretty key. So BSE is increasingly lent into this. We've come to the conclusion it's more and more important for us, actually.
Looking forward, what do you see as the biggest challenges and opportunities for social impact investment in the UK? And are there particular social issues that you are passionate about addressing, but haven't yet found a way to make them investable?
The biggest challenge is the scale one. I would say that, hey, we've grown this market, we've got lots of things that work, but the scale of the challenges we're trying to deal with is just another level of size. People with ill health conditions are not able to get treated because of capacity in the health service, people who got poor housing, educational underattainment, particularly among certain communities and groups. I mean, these problems are big and they need a lot of money. And while there are increasingly proven models of how impact investment can help, it's never the only tool, but it can help solve some of these problems. We're just not at the scale yet. So that's the scale, but also the opportunity. I mean, that's the challenge, but also the opportunity. The challenge is we're not at the level we need to be to make a real difference. The opportunity is we have in many areas increasing evidence that there is the potential to have that impact on the big prize of making a real difference. And then on the social challenges where I'd love to address them, but it's really hard from an investment perspective, which is criminal justice area I'm fascinated by. I think it's incredibly important. I think we do pretty badly in the UK on a lot of measures. We have a court system with massive backlogs. We lock up a large percentage of population of people who mainly then reoffend because they're treated, prison system doesn't help. We very bad at housing people when they come out of prison, which causes them to reoffend again. Public have very low faith in the system, low trust in policing out. The whole, but most indicators, it's pretty bad experience for like everyone involved, victims of crime, criminals, people who work in it. It's generally pretty poor. And there's a kind of fundamental bedrock for civilized society that you get that right. But it's actually, investment as a tool I haven't found a way we can get there yet. There's also other problems we can tackle more effectively, but from a purely personal perspective, that's an issue I really am incredibly interested in and passionate about. And actually, the impact investment tool is not well suited, at least not at the moment, at least not in the UK context.
Circling back to your comment about the need for more scale, what needs to change to make that possible?
Part of it is time, and it does take time to build these things and to see investment through their life cycle and out the other side with returns, with evidence that then these people can come in. So we just got to get that. We talked right at the beginning about the misconception. I think this sort of simplistic views of trade-off. People say, oh, well, this is seeking social impact. It must be concessionary or must be riskier. Well, in some cases, yes, but in a lot of cases, no. And there's some perception problems there. I think there's also a bit of a institutional sort of built-in bias in, like in any big organization, particularly in big fund managers, to doing the same thing again. And also there's a chicken and egg problem that the financial service industry likes doing very big things because its transaction costs are lower. And if you can get something to a big scale, then lots of people invest in it. But to get it to the big scale, people have got to invest in it first. So there's this chicken and egg problem about you can only get big when you've got big already.
you just start like with a overview of LeapFrog? You've hinted at what the origins are, but I think it's expanded beyond that. What the mission is, maybe start at the 10,000 meter level and then
zoom in a bit. Yeah. So the best way to understand LeapFrog, we see ourselves as one of the world's leading impact investment firms and define impact investing as profit with purpose. So this is a fully commercial activity. We don't believe in trade-offs at all. We believe that it's possible to build big businesses that are serving low-income people, helping low-income people to get access to the services they need. At the same time, build big organizations and make money for investors. So our theory of change, if you like, is around really just that, providing emerging services to what we call emerging consumers. So it's all about the idea that if you look at poverty, what is really happening there, you have a large group of low-income people who don't have access to healthcare, to financial services, insurance payments, etc. And if we can help low-income people get access to these essential services that everybody else in the world takes for granted, that will reduce poverty and help to lift that group up towards the middle class. And that's where we get with our profit from, because we're building businesses that do that, and our purpose from, because there's so much social good that you can do by providing these services to people. So that kind of in a nutshell is the theory of change at LeapFrog. Essential services for low-income people and getting both profit and purpose from that.
by regionally focused on Africa and Southeast Asia. I mean, those are the only two regions you focus on.
So for us, a really important theme has always been scale. We were never very interested in the idea of funding projects where you could help 1,000 people or even 10,000 people. We always thought about, how can we invest in businesses that are helping to lift millions of people out of poverty? And if you want to do that, you need to think about the markets where there are large numbers of low-income people. And for us, there's kind of three clusters. There's Southeast Asia, where we're very active in places like Vietnam, Philippines, Indonesia. And then you have South Asia, where India is our single biggest market. That accounts for about a third of our portfolio. And then finally, Sub-Saharan Africa, where we're very active. But we're not, we're certainly not global. We're not in China or not even in Latin America. We're just very intentional about these handful of large low-income markets that we invest in across Asia and Africa.
You just mentioned India. I've worked in a lot of these places. How does it work to invest in India? Because the problem there is always getting your money out of there. Could you summarize how you're investing there?
Yeah, so we invest in a bunch of different things in India, including insurance businesses that insure low-income people, lots of lending businesses who are trying to do loans not dissimilar to, some of the micro lenders, that kind of strategy. We've even done some stuff in healthcare now, also in technology. Of course, none of these countries are easy places to do business. There are reasons why people that invest there seek high returns. But oddly enough, we've never had a really difficult exit challenge in India. Reason being that actually most of the time investors are pretty excited about India just because the total addressable market in India is always absolutely massive and the growth potential is always enormous. And I think in a funny way, we are quite fortunate that, strategic investors who are largely oriented in, say, Western markets or maybe in Japan, are kind of sat there in sectors like insurance and healthcare saying, oh my goodness, where is the growth going to come from? And, the answer to that, I think, is perhaps partly now in changes in technology, but I think a big part of it is countries like India. If you're running an insurance company today, it's going to be very tough to grow in Germany or the UK, but, India is always an exciting growth opportunity. So we've done quite well usually by selling our investments in India to strategic investors who want to take the business on to the next stage.
So you focused on Southeast Asia and Africa because of the large numbers for scale. What about financial services? I guess that was the initial focus. And it sounds like that's expanded beyond the insurance. And later on, you got into healthcare. Could you maybe speak on that?
Yeah, sure. So we started in insurance, and I think it's played out very well. insurance penetration was very low in all of these countries. And yet the people that lived there lived very risky, very vulnerable lives where, people were constantly suffering and kind of slipping backwards economically because of adverse health events, or maybe the father of the family or the mother dies, or maybe they have like a key livelihood asset that goes missing. So, but nobody had any way to formally protect themselves against those kind of risks. So the first fund was all about just really that theory of how can we help the insurance sector to expand and serve more low-income people and help to protect them against those risks. And we had all sorts of success stories with that. I included, a health product that we did with a company called Mahindra that reached 2 million people. We had a company we invested with called Bima, which I think sold something like 30 million policies period that we were invested there. That was completely digital, which is the reason they were able to scale so fast. And then in our second fund, we said, well, that's worked really well. How do we take this into other areas of financial services? So we started investing in credit businesses, and we invested in a few that were known as NBFCs in India, as well as across Africa. And then finally, in our third fund, we expanded that again to include healthcare, which was a natural adjacency to the health insurance expertise that we already had. But even today, although we have expanded from where we were in terms of just being in insurance, right now we're in financial services and healthcare, and that's it. We don't do anything else. We've never been about, investing in every kind of impactful business we can think of. So we're not impact generalists. We're very specialized around, okay, we know how to do financial services, we know how to do healthcare, and that's it. We don't go outside of those tram lines. So it's still very carefully defined what we're doing and very intentional.
How many funds do you have?
4 funds. We have 3 kind of standard, typical GPLP sort of private equity style funds. And then we have 1 separate managed account, which is with Prudential, the US Prudential, who put some money into a vehicle that we use to invest just in life insurance in Africa.
These are closed-ended funds that you...
All closed-ended funds. The original idea was that when LeapFrog was first started, we wanted the funds to be as close to standard as possible, because we, the whole, at that time, the whole impact investing story was so new and so different that we didn't want to have too many wacky things in the structure. So we just went for a vanilla private equity structure. Yeah.
And from the get-go, you were in both Africa and Southeast Asia?
And South Asia, yeah. So Africa and Asia from the beginning.
Okay.
Yeah.
So the funds have no regional focus. They're covering both of those. The first fund was much more insurance focused. Is that right?
Yeah, that's right.
Yeah. How did Andy, what was the genesis of him focusing on this and starting LeapFrog?
Well, yeah, he'd had a few, I suppose, formative experiences. He was at Ashoka, and I think he'd had some sort of induction with the general notion of social impact investing. He'd worked with a lot of social entrepreneurs, etc. But I think, if you were to ask him what was the genesis of how he began LeapFrog, he worked for a poverty economist called Amartya Sen at Trinity College. And he did a project during that period around trying to sell irrigation equipment to farmers in Rajasthan. And he had a hell of a tough time doing it because basically trying to flog this irrigation kit to farmers, and he'd say to them that there's a 90% chance this thing worked, and he couldn't make any sales. And he found that just baffling. Why did these guys not want to buy this irrigation equipment? 90% chance of success or whatever it was. And what he started to realize is that these relatively low-income farmers could not take any risk, because the problem they had is the 10% chance with such a severe downside for them. If they, if the irrigation didn't work, then they'd spend all that money, and then, they were really going to be in trouble. And he realized that, that inability to manage risk was just so critical to life. And that was really what got him into the insurance sector and kind of, working to try and develop the insurance sector in a way that it protected more people and allowed people to actually take the risks they needed to do to improve their lives.
What's your average ticket size? I'm just trying to make sure I cover the base here.
Yeah, so right now, anywhere between 10 and 70 million US dollars. Our most recent fund, for example, was $740 million.
And AUM, is that something you publish?
Yep, so about $2 billion at this point.
Right. And then what do you benchmark these funds against?
Well, for us, the critical thing is that, as I say, we're completely commercial in our orientation. We don't believe in trade-offs. So we benchmark ourselves against, the private equity peer group. We see no good reason why we should be underperforming our private equity peers just because we're doing impact. In fact, we think if anything, it enhances returns.
Yeah.
So that's how we benchmark ourselves.
I'd like to try to see if we can drill down into your investment strategy. How do you actually select an investment and make your investment decisions logistically, tactically, operationally? How does LeapFrog deploy capital?
So I think the first thing to say is that everybody who works at LeapFrog is very specialized in terms of country and market. So, I spend most of my time on India. There are a number of other people in the team who do the same. There are others now who are based in Nigeria or Kenya or whatever it may be. And everybody's either a financial services specialist or a healthcare specialist. So all of the investment people are very, very close to their sectors and their markets, to spend all their time there, et cetera, et cetera, et cetera. And they're so specialized that they just go around meeting CEOs of companies in that sector. That's all they do. Yeah. So they're very close to what is going on in these places. And so, very practically, the key to deployment is that kind of localism that you want, that we're very local and very specialist. I mean, there shouldn't be anybody in, for example, the Kenyan insurance industry who doesn't know the relevant person at LeapFrog for what they're doing. And then we just go around meeting CEOs all the time, figuring out what's going on. Sooner or later, all these companies, usually they're growing. So sooner or later, they have some sort of capital need. And then usually we'll try and have a proprietary conversation with them about whether we can be the provider of capital. We don't like auctions or participate. All private equity funds say that, but we really don't, we really don't like participating in auctions. We like to go and do proprietary things with people who we feel are kind of values aligned. And then in terms of how we make the decisions, typically, a partner will, or more often actually two partners will get together to look at a deal. We have an investment committee, which has effectively 3 stages that you have to go through to get approval. And to get that approval, the deal team will write up a long paper, which includes all of the usual stuff, of course, around the market and the company and the other shareholders and so on, the strategy of the business. But the really critical thing is it'll include a valuation section and a impact section that are equals in the decision-making process. So there's no trade-off. And this is not something where we're basically doing old-fashioned private equity and then just giving it some impact lipstick at the end. The impact analysis is just as serious as the financial analysis. And each investment has to meet both bars. So it has to be a good financial investment and it has to help us to reach our impact objectives, which at this point involve reaching millions of low-income people.
What are the screens that you have, both financial and non-financial?
So financially, we try and make what we refer to as top quartile private equity style returns. But essentially, the financial metric is standard private equity returns. And the impact metric is that we will set ourselves a goal for the number of low-income people we want to reach for each fund. So I think the latest fund's 100 million people. And then each investment has to make a material contribution towards that. So if I come along with an investment and say, hey, this thing's going to do 30% return, everyone will go, that's great. What's the impact metric? And if I say, well, unfortunately, it's only reaching 5,000 low-income, people will say, well, that's not good enough. That's not giving us a good enough impact profile towards our target of wanting to reach 100 million people. And so both are taken just as seriously and measured just as seriously.
You're working only in developing countries, and I know a bit about it personally, having spent a lot of my career living and working in a lot of these places. And a lot of these places are places where the rule of law isn't always the rule. And when there's money involved, then there's often corruption in some of these places on an industrial scale. How do you vet your targets before you make the investment? Then once you make the investment, how do you do ongoing due diligence once the company is in your portfolio so that things don't go pear-shaped after that.
Yeah, it's a good question. I think there are two answers to it. One is that, since the beginning of our first fund, we've always been well supported by the development finance institutions. So people like IFC and CDC and DEG and that, that group of organizations, DFC, now OPEC as it used to be known. And for that reason, all the anti-corruption sort of legal stuff, we've never had an inch. We've always been legally absolutely insistent on all of our companies operating to the highest possible standards. So when we do investment agreements with people, it is always essential that they sign up to a set of rules around issues like corruption and bribery and anti-money laundering, which are, very stringent. So legally, that's the answer. Now, of course, the problem with that is that if somebody was corrupt, would they really be put off by signing some bit of paper with a long list of, prohibitions? Who knows? But we talk a lot about partner selection, which means we try very hard to find businesses that are operating to world-class standards in terms of governance around these issues. So, and a good example of that is Mahindra Group, which was one of our first partners in India. We invested in their insurance business, which was a fantastic outcome for us, both financially and from an impact perspective. But I remember we met them maybe 2012. And around that time, The Economist had done a profile of Anand Mahindra, who is the kind of patriarch of the group, where it depicted him in the cartoon as a Jedi fighting against all these sort of corrupt government bureaucrats who are all in these kind of dark robes. I think that cartoon put it very well. That's who we want to find. We want to find people in these countries where the governance is absolutely top notch and they're not getting mixed up in the kinds of issues you talked about. And unfortunately, it means you have to walk away from a lot of stuff from time to time, but we just always zero tolerance.
Maybe you could give me one or two examples of investment that you think would capture your strategy, both from a financial and impact perspective. Take me through, how did you find them, or how did they come in your pipeline, and then how did you make the investment?
Sure. I'll give you a couple of examples. One that I guess people kind of like hearing about is a company called Bima, which is this mobile insurance business that we invested in 2013. And Bima, essentially what it did at the time was partner with mobile operators to sell insurance to their customer bases. And that was pretty exciting because, as you will know, whatever other limitations exist in emerging markets, the vast majority of the population have a mobile phone. Actually, today, it's even better than that. The majority of the population now pretty much have smartphones that they can use for different things. And the mobile operators are very dominant. They have incredible data that is very predictive and very easy to use. They have payment mechanisms that you can use easily to collect payment for the service that you're providing. They have fantastic brands, which really matters a lot in insurance. Insurance is all about trust. And many people in the developing world, their first experience with insurance will very often have been, being scammed by somebody who said they were going to provide protection against something. So Bima had developed this means of partnering with mobile operators and selling life and health insurance to their customer bases. And this thing grew incredibly quickly. When we first invested in them, they had $1 million of revenue. By the time we exited, it was $30 million of revenue. And they'd gone from, I think, maybe 3 or 4 markets to being present in 9 markets across Ghana, Tanzania, Bangladesh, Indonesia, Sri Lanka, a lot of big places. So that did incredibly well for us. And at the same time, because they were using all of this mobile infrastructure, they brought the cost of providing insurance down to, $1 a month, if that, sometimes actually less than that, for covers of, a few $1,000s. And I think something like 80% of the Bima customer base had never had insurance before. And certainly the health insurance piece was incredibly new to the customer base. So that did incredibly well for us. And eventually, back in, I think, 2018, we ended up getting an approach from Allianz and sold our shareholding to Allianz. And for them, there were 3 things, really. First of all, they were fascinated by this company that was selling insurance digitally and doing so successfully and scaling quickly. And they felt there would be a lot of lessons for the core business. Secondly, the impact story was also incredible. I mean, the business, I think, had reached 30 million low-income customers over, the period that LeapFrog had been invested. And then finally, it's just a lot of growth. And, Allianz were sitting there very worried about digital disruption, very worried about finding growth in Germany and in other markets. And so then this was really an appealing prospect to buy into a company that's growing quickly.
Are most of your exits trade sales?
That's been true historically, although I think increasingly the equity markets are doing so well that we'll have one or two businesses come to market relatively soon. But historically, yes, selling to Western strategics has been a kind of our forte.
Have you ever sold to LP, limited partners? Or?
Yes, that's happened. Yeah, because very often the LPs kind of have a ringside seat, so they'll see what we're doing, and if they see something you really like, very often they'll be preemptive.
How do you spell Bima?
Bima.
Well, even I can remember that one.
Yeah, so it means insurance in many languages, Swahili, Hindi, and so on. So it's quite a good brand for just using across a bunch of different emerging markets.
Do you have another example, perhaps?
Yeah, so it's another one that, I'm personally very close to, is a business that is now known as Zeps, but historically used to be known as WorldRemit. Zeps is a holding company they set up to own WorldRemit and another business they acquired called Sendwave. And this was a business that was started by a Somali, I don't want to say Somalian because he's from Somaliland rather than Somalia, but so I forget exactly what the appropriate terminology is here. But a guy called Ismail Ahmed, who was a migrant, left Somaliland at the height of the civil war in the 1980s, made it to the UK. He has an incredible life story about it. He went from that to launching a remittance business, which in a way does something very simple, which is transfers money from people in Western markets back to their families, usually in lower income emerging markets. That is a market that two interesting things about it. The first is that it's very large. I think in the formal market, something like $600 billion gets transferred every year. In the informal market, it's probably the same guess. So you're probably talking about something like $1 trillion total market size. And historically was dominated by Western Union, used to really rip people off. So they would, charge people a fortune to transfer the money, and very often the service wasn't great. And what Ishmael did was to figure out that using digital technology, you could just bring the cost of this service down dramatically, which is what he did. So he made the whole experience digital. You could do this on your mobile phone or you could go on the website on your computer, transfer money, and it would go into people's mobile money accounts in Africa or Asia or wherever they happen to be. So two things happened. First of all, he grew this business to, an enormous scale. I could get you the exact revenue number they're at now, but it's in the hundreds of millions of dollars, the revenue. But it's also just slashed the costs of sending money home for migrants. It means there's much less leakage to the migrants, much more money makes it back to their families. And that has a huge impact at home. And it's very consistent with our strategy, both on the profit side and on the purpose side, because about 2/3 of the money they send goes to Africa.
Yeah. Have you exited that business or are you still holding it?
No, we just had a pretty good evaluation event where actually it's public, but the latest round of investment was done at $5 billion evaluation, $5 billion. So, obviously we were in that in the relatively early stages. So it's been a very good outcome for us.
How do you avoid greenwashing or impact washing? Because, of course, once you have a kind of a measurement report card system, then you're going to have people gaming the system, right?
Well, I think we have two inherent advantages here. One is that, we're investing intentionally around a very particular problem, which is poverty. And we've got a way of defining our theory of change around helping low-income people to access essential services. We are not a generalist. And I think if you're an impact generalist, so if you just say, well, we invest in companies that have an impact, then it's very easy to become engaged in impact washing because, you can figure out some way to say that just about any company has some sort of impact. And we see that all the time, impact investors investing in random companies that are just companies, and they find some ways to say, oh, they employed this number of people, or, 10% of the homes they built were less than, this threshold of affordability. Yeah. And that is where I think people get into trouble. We're much more specific than that. If you present RIC a case where you have a company that is not reaching a number of low-income people that will help us get to our goal of 100 million for the fund, you're not going to get it through. And the fact that we are so specific, I think, is really helpful. The second thing is that we have been impact from the beginning, which means that, the impact piece, the requirement to produce large-scale social impact has always been in the DNA. It's in every investment. Every investment we've ever done has this. Whereas a lot of what you see today is a bunch of private equity guys who have suddenly decided they're going to do impact investing and then, go out and come up with whatever framework. But is it really there in the DNA of their organizations? I think it's a challenge, right? So I think for us, it's a combination of the fact it's so authentically within our DNA to do the impact piece properly. We're so specific about the impact that we want to try and have. And at this point, we've been working so hard in our markets for such a long period of time that we feel like we know who the good people are and who the baddies are.
I have the impression that our LeapFrog's USP is bringing expertise beyond the board level. And once you have an investment, you have abilities to leverage strong operational priorities into your investments. Can you describe for me what does that look like in practice?
So there's a few different aspects to it. First of all, I think the fact that we're also specialized helps a lot. And the fact that so many people on our team come from operating backgrounds rather than financial backgrounds is really helpful around this. And really, there are two or three aspects to it. The first is that, all of the companies that we invest in are oriented towards lower income consumers, which is a very specific group of people to try and serve. You have to design products and services in a very affordable, very kind of straightforward way. And so we've developed a lot of competence really around designing these sorts of products. So for example, in our first fund, one of the things we tried to do was expand the reach of health insurance via the portfolio companies. We partnered with Mahindra Insurance to design health insurance products in India. Very simple, cashless hospitalization product. If you get hospitalized, you go to a hospital, you're covered for this much. And that was very popular. That reached, I think it has something like 2 million customers now, if I'm not mistaken. But I think it was about 1 million customers by the time we exited. It's now 2 million. Numbers are always big in India, but that was a real success story. And we've done that with a couple of other portfolio companies. So, partnering with companies that have an existing sales footprint and working out what other essential services like health insurance you can get out there. That's a big part of it. We've developed two other areas of competence, both based on feedback really that we've had from the management teams that we backed around what would be helpful. The first is something called the Customer Experience Launchpad. We always come up with these names for these initiatives that I don't know, slightly cheesy. But, particularly now in the age where even the lowest income customers very often have smartphones, a lot of the companies were wrestling with how to do digital really well. So we thought we'd centralize that. And we have a couple of people who specialize in, how to develop applications in a way that customers can engage with you over their smartphones. That's been a big success. Did a big project around that in Ghana with a company called My Life that we invested in there. And then the final one is another cheesy name, but it's called the Talent Accelerator. And that was really created around the idea that, talent for all these companies that we invest in, retaining and motivating talented people is a constant challenge. And we often found that the companies we were investing in weren't necessarily of the size they could offer really exciting development opportunities. But if we pulled them all together, we could sort of set up interesting leadership courses and do interesting things with leadership teams at the LeapFrog level. So we put that together as well. So these are the kind of things where there's the product design piece or the customer experience piece or the talent piece. These are the kinds of things that we're doing that we think make us distinct from other people.
How about your investors? Could you describe the typical profile? I guess I'm interested to know, are they investing with LeapFrog out of passion or because of the returns or both?
It's changed over time. So in our first fund, we had some passionate people. So Pierre Amidio, the founder of eBay, invested in our first fund, George Soros, and then a lot of development finance institutions. So, people like ISC and EIB and all, people who are interested in development. And that first fund was 135 million. And then, as we started to do more in insurance, we found we got more interest from insurance companies. So in our second fund, we had a bunch of different insurance companies come in as well. But what is fantastic from my perspective is if you look at our third fund, lots and lots of commercial investment, because as we proved the experience out, as we delivered the returns on both the financial side and the impact side, plus impact investing became better known, people wanted to do more. We started to get a lot more interest from, pension funds, big investment institutions, those kinds of people. I think it's kind of steadily institutionalized over time. And now, the people that invest in LeapFrog now are there usually because they want to do something in the impact investing space, but they're very often not people who are in a position to compromise their fiduciary obligations. So the fact that we have a track record with real returns, I think is fabulous for them.
But are there any downsides or risks that are unique, let's say, to your investors?
The risk they worry about the most is the reputational risk. They all worry about, something going wrong at one of the portfolio companies, particularly portfolio companies dealing with low-income people. Will there be some sort of reputational issue? That's the risk that they worry about. I don't think we've slipped up. We're really careful about that because it's so existential for us. If we were to get an issue like that wrong for LeapFrog, I think that could be incredibly damaging.
You mean reputational in the sense of like you find out something about underage children in a factory and it ends up on the front page?
Yeah, something like that. Well, it wouldn't necessarily have to be as bad as that. So, if there was a company, maybe in the lending industry, sometimes collection practices in the countries we operate in can become quite nasty. Something like that would scare us a lot. Or a lender charging excessive interest rates to somebody. And, these things can get to the front pages of the newspapers before you've even realized what's going on. So those are the risks people worry about. We've done well on that stuff. I honestly don't think we've had a serious issue around those kinds of problems, but only, we're incredibly careful about it. But just to give you authentic answer, we do face risks that happen all the time. Currency is a huge problem for us, right? So in currency, we've had one or two investments where we've done pretty well local currency wise and had it all wiped out by devaluation. That's been a problem. It's also true that regulators in the countries we work in are much less predictable than they are in Europe or the US. So we've had a couple of times where regulatory interventions have caused our businesses severe problems. So those tend to be the big two market risks that we face, currency and regulation.
What are the opportunities out there for technology to enable, let's say over 10 years, that could scale access to essential financial and healthcare services for low income, maybe low to middle income populations? And maybe you could give any example that comes to your mind.
Yeah. At the heart of all this, and, this is perhaps very obvious to you, is the fact that smartphone penetration is just rocketed, even amongst the low income people in Asia and Africa over the last few years. And as you know, and I know, that smartphones can just radically alter the affordability of key services and actually allow you to totally reimagine the way that services are delivered. And which of the two of us could have imagined Uber 5 to 10 years ago in the way that that's transformed how we access transport, right? Or Airbnb. And the exciting thing is there's a chance now, all of these different services you describe, there's a chance to kind of revolutionize all of these things for low-income people. And I would look at it across 2 or 3 sectors. So telemedicine, for example, we have a business that is engaged in providing telemedicine to low-income people who haven't had access to formal care from doctors before because, going to the doctor means taking time off their work and traveling to the city. And all that stuff disappears straight away. So have a 5-minute call with a doctor, sometimes a video call if you go to the local pharmacy and use the Wi-Fi there. So telemedicine is a great example of that. I think payments are incredibly important. I always known to the team that people tend to underestimate the social impact of easing payment mechanisms. It's a real pain in the developing world for all business people that these economies run on cash. And if you want to collect monthly payment from a customer, you have to go to a village in Uttar Pradesh and pick up some physical notes. Now, all of that, the more payment mechanisms become, digital payment mechanisms become better and allow people to pay for things quicker, that makes easier to sell people solar home systems or affordable housing plots. It's just suddenly that whole cost of doing the payment piece, all of that goes away, or to lend to people. And we have a business called Jumo, which provides digital loans to people. And it does that by using the data in a smartphone to look at their risk profile and underwrite their risk. We could go on and on. We could go all night about this stuff. I suppose it's probably not all that interesting because it's so well known. Once you put the smartphone in somebody's hand, there's a million things that you can do for them that had never been possible before. And I just think it's terrifically exciting.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.